Well, we've turned a little bit more cautious here in the near term, as was mentioned. If you look at the month of June, we've been up almost 7-8% since the beginning of June. I think it's normal to have a period of correction. By the way, we usually have 2 to 3, 5% pullbacks in a given year. So the fact that we were up at these elevated levels, we're above our target, we're just waiting for a better buying opportunity, because I think in many ways people had gotten a little too optimistic about what the Fed is going to do, about the trade issues. And I think a lot of that will have some disappointment here in the near term and provide us with another opportunity.
Chris, 2 days in a row of selling. What's your take?
I would agree with the prior comment, is that this market has been oversold in June. Remember, May was such a terrible month. June, the counter, was a very positive month. I think the market needs to come back and assess where the Fed is going to go. And it certainly got ahead of itself in terms of Federal Reserve expectations.
Now, Morgan Stanley downgraded its outlook for global stocks today, saying investors haven't fully priced in weaker GDP data, and that, quote, the positives of easier policy will be offset by the negatives of weaker growth. It's the classic central point, Mike, for will you only get a cut if the evidence is bad enough? I mean, the other point in the Morgan Stanley note, which has got a lot of attention today, is generally where valuations are and where global equities have got year to date as well.
Exactly. I mean, valuations to me are certainly not a decisive reason to own the market. They're not stretched, but if you believe they're fair, it's only because you think that this slowdown is just a little bit of a lull and not a really persistent decline in economic activity. So that is where the front line of the debate is right now. Has the market priced in enough of softness in earnings by now, because it's only going to be this plateau period and then it's going to pick up again? If your bet is no, if your bet is that it's going to be a more persistent decline in the global economy that's going to drag earnings estimates lower into next year, then I think it makes sense to turn a little more cautious. What's interesting to me, though, from a sentiment perspective is you have Citigroup going underweight global equities by a small bit relatively recently. You do have a lot of caution out there. The consensus sell side target for the S&P is below where we're trading right now. So that tells me that nobody's got high expectations, and on a contrary basis, that's probably a positive, because it'd be unusual for a lot of these firms all at once to call the top.
Chris, looking at this market, would you have high expectations, or are you cautious?
Yeah, no, I'd have lower expectations. I think the market's gotten ahead of itself, Morgan, and I would agree with what Mike said. It's normally a contrary indicator, but I think most of these firms are really looking around the globe and realizing that the economies are very slow. Obviously with Europe, I've heard people, my equity desk, make the comment that Japan looks like one of the better economies. That's really saying the scale is slow growth, and I think we're going to see sloppy earnings. So not horribly disappointing, but sloppy earnings reports and gloomy outlooks from companies. They've got to be more pessimistic and more realistic in their expectations.